Thank you for tuning in today for this discussion on a topic that's very close to my heart. I'm Antonia Burridge, a co-founder of the PwC Raise Ventures team, a team focused on helping high-growth, early-stage companies to fundraise their Series A and B. I'm also the co-founder of a health tech startup, and I'm looking forward to being your host today. I'm delighted to be joined by two investors and my colleague, and today we're going to discuss the findings of a report that we published earlier this year, looking at the unique challenges that female founders face when they are fundraising and some potential recommendations. So, welcome to Daina Spedding, Billy Fox. Great to have you here. I'm really looking forward to hearing your thoughts. You're both definitely qualified on this, given your investment experience. Before we go into that discussion, I'm going to hand over to my colleague, Jenny Chance, who's going to give out some output on the findings of the report.
So thanks, Antonia. Equally super passionate about this topic. I led the research that we did earlier this year. As we researched the challenges that female founders face when fundraising, but we wanted to contribute positively to that and give some positive recommendations about what other female founders could do. But it was spurred by this awful statistic that only 3% of global VC funding in 2020 went to female-led businesses. And we've looked it up and the stats just haven't changed in that time. In fact, Sifted suggested that it got worse, particularly for women in Europe and in tech. But we wanted to get behind that number and understand why it was happening and what the situation was really like for women who were fundraising. But we wanted to give constructive advice, but also inspiration to other women that it could be done despite the odds. So earlier this year, we interviewed 40 female founders in 25 different countries, and they'd raised from seed through to Series D, so hundreds of millions of dollars between them. And we boiled down what they said into 5 key recommendations. And the report is on the pwc.com website. Also, it's been put in the chat now, so please do take a look. But today we're here to hear the other side of the debate, what it's like on the other side of the table. So please, anybody viewing, please put your questions in the chat and I'll take them at the end. But now, Antonia, over to you.
Brilliant. So, Daina and Billy, really looking forward to hearing your thoughts, but particularly how it relates to your personal experience. Basically, the more practical tips we can get, the better. So if we could kick off with you introducing yourselves and answering the first question, which is what should founders think about when choosing an investor? As we know, investment levels are so low. There are so many investors out there. How do you maximize your chances of success? Daina.
Thanks, Antonia, and thank you for having me. I'm Daina. I am investor at BGF, and we are the most active growth stage investor in female-led companies in UK, having backed over 50 businesses over the last 12 years since we were founded. I meet and speak to female founders all the time, and like you, I'm really passionate to get more funding to more diverse founding teams. And I guess the simplest advice I can give is that 2 bottlenecks I have personally seen and come across day in, day out is that why we can't help or investors can't help and actually invest is either the stage of the business and how much they're looking to raise. So having actually done the research in terms of is your situation fitting the investor's investment mandate and criteria is useful, so you don't need to waste time meeting 100+ investors, even if you're perfect at your pitch. It won't get through if you don't meet their investment mandate criteria. That's my kind of first advice. And second of advice, I would say, is business model and sector. You have much more chance engaging investors who understand your space, who actually like to invest in your space, hopefully have either made money or have invested in companies, not necessarily direct competitors, but in kind of a related field or similar value chain. So they actually get what you're trying to build and it really resonates with them.
Yeah, makes sense. And in terms of where you should find that information about which investor to approach, any thoughts on?
I think that if you just start with Google or LinkedIn, probably in terms of which are the companies which have successfully scaled and raised capital in the space, you can easily find who invested in terms of funds, or you can actually speak to other founders and ask who they raised from. But most portfolio companies are probably published on investors' websites. So there's obviously other third-party firms and even PitchBook and Bohorst and many others where you can get that information. But even on Google and LinkedIn, you can find quite a lot.
Brilliant. Billy.
Thank you so much for having me. I'm Billy from Active Partners, and we are a fund that is purely focused on backing the consumer economy. And what we mean by that is really the businesses and brands that define consumer categories or even kind of create entirely new ones. So for us, those are businesses that look and sound amazing, have communities that do lots of the marketing legwork for them, but they all have a best-in-class product or service at the core of what they do, because that's how we create something that lasts for a generation rather than flash in the pan. We too have been championing female founders for a long time. It's definitely accelerated over the last 5 years. So when I joined Active, we had 3 female founders in our portfolio, and now we have close to 40%. So still not where we'd like it to be at 50-50, but it's been a conscious effort to get it as close there as possible. In terms of what to think about when choosing the right investor, I think the easiest way to think about it sometimes is a bit like a marriage. Yep. You are getting into a long-term relationship with someone that you are going to go through both good and bad times with. The good times are always good, and I don't think you should worry about how that investor is going to behave when you're hitting your business plan and everything's going really well. It's much more about, how do I think this investor is going to react when things don't go to plan? And I need to call them with a serious problem that could impact their investment, but also the business. And you want to make sure that person you're happy to laugh and cry with in front of. And it can be quite difficult to ascertain that, especially if you're kind of in a business environment. But these things take time. Deals often take up to 3 to 6 months, depending on the size of the ticket that the fund is writing. So that will eke itself out to make sure that you are aligned with both the vision for where the business needs to get to for everyone to have a happy outcome, but also the values that are important to both the founder and the fund and investor.
So you've got that time to make that decision. It's not, but I presume you can get quite an impression pretty quickly. Do you think as well?
I think so.
Yeah.
I actually think that women are particularly good at intuition and that initial feeling, gut feeling, like you said, it's almost like speed dating. Yeah. Within first 10 to 15 minutes, yes, you might not know a lot about the other party, but you do feel whether you actually click and whether you like to actually be in the same room and whether you can engage. Trust does take time to build, but I think that initial impression, if something doesn't feel quite right, it probably is not right.
Yeah. That came through so many times from the women we spoke to about this gut feel, intuition, and also that analogy about speed dating, matchmaking, marriage, that really going with your gut feel as well.
Very powerful. Right, so now we're into the pitch meeting, the all-important pitch meeting, founder to investor. So what would be very interesting to hear is, in your experience, have you seen a difference in how female founders pitch to male founders? And also, any recommendations on how to maximize the impact of your pitch? Should we go with Billy?
Sure. So obviously, both Daina and I look at consumer, so we're quite privileged in the fact that we do get to see a lot of female founders, because there is a natural skew for female founders, generalizing here, to build creative businesses that tend to lead towards consumer. So we see a lot of both. And I think it's very difficult to pinpoint exact differences between how male and female investors pitch. Everyone has a different style. It can be confident, it can be shy, it can be slightly arrogant, it can be understated, and those aren't necessarily gender-specific ones. I think the one particular area that I notice it in is solution-based businesses to problems that are particularly felt by women. So those are female founders that feel aggrieved and angry that they're constantly pushed to buy services and products that are designed by men for women, which is so often the case in science and all the FMCG senior board members, all that sort of stuff. And it really comes across strongly as an investor when a female founder has been in that position where she's been given a male product and she's so angry that she has to quit her job and go and solve this problem. And that fire in the belly is so important for us investors to know that there's a real gripe to go out and make this problem right. So that's where I'd say there's a particular difference. In terms of the
impact,
the kind of how can female founders can pitch better, I think practice does make perfect, and you need to be all over your pitch and all details of it, especially if you're early stage, so you don't have a finance function or a marketing function. You are the sole person covering those. You need to be really well versed in the numbers in your deck.
Yeah.
And then another point that this is personal to me as an investor is I personally don't like when founders sit behind slide decks. I like it to be a much more conversational, two-way conversation.
Yeah.
And so I would say be prepared to either pitch to slide decks or pitch to the vision and, without the slides in front of you.
Brilliant. And if you have those slides, what would be the maximum length that pitch could be? Because everyone they want to talk about their business.
So I personally tune out after 15 minutes.
Fine.
I think 10 to 15 is the perfect time to portray you and why you're the right person to build this business, what this business does, and what the big vision is.
Yeah, brilliant. Daina.
I would say that having practiced and being confident and obviously knowledgeable about your business, market competitors, yes, is really important. But at the same time, be flexible and pragmatic in terms of tailoring the approach and conversation. Like you, Billy, I much prefer to probably have one-on-one discussion. And actually, I think most female founders, in my experience, feel actually more comfortable to actually have one-on-one conversation in more informal setting instead of doing pitch on stage or in front of panel investors. And that way you can actually find out more about each other in a more relaxed environment to see whether there's a match or not. And in that instance, I think it's really important for actually to be a two-way street where the founder asks questions about how much you know about the space. Have you done other investments in this? Because if you almost go in a practice role of, 15 or 20 minutes, I want to go through 20 slides and never stopping, never kind of reflecting on a live situation, I think many investors will just zone out. It basically after 5-10 minutes, they realize this is not for us. So you're far better really tailoring and perhaps focusing on the things which either matter or when an investor wants to ask questions because they are not familiar with either business plan or competitive landscape or how the product market channel mix, whatever it is. Don't just have the same drill and slide deck without any kind of flexibility to adjust it to actually a live situation.
So being confident, but also almost setting up the situation, understanding the background position and then tailoring it accordingly.
Yeah. I think there's also a point in there that if you know everything off by heart in the business and the deck, if an investor is one of those investors that likes to jump in with random questions that ruins your flow, you don't suddenly get a bit lost and have to go back to the deck and follow the flow. You're very happy to take a segue and answer a completely separate question and let that conversation go where it's going to go.
It's almost like a job interview or almost like a first date. You want to have a general engagement because I think the best almost feedback I think is like when you meet somebody and you think, oh my God, half an hour has passed. I wish I could spend like 2 more hours to actually speaking to you, finding more about you, what you are building, because it's so interesting and engaging instead of feelings that you are just one out of, 30 investors or how many they pitch and they tell the same script to everybody without any kind of authentic storytelling or engagement.
Which is very important.
An interesting point that came up was around emotion and how women tend to show emotion more in the passionate storytelling. Do you find that's the case? Does that kind of come through?
I think probably yes, but not by a huge margin. I've seen male founders portray huge emotion about why they're setting up this, and perhaps that actually might hit harder than a female founder doing it because it might be slightly off cue for the male-female split of generalists who shows more emotion. But it's a huge part of the storytelling and what you're building is that emotion. So everybody has to have emotion in the business they're building.
And I think it kind of translates into selling skills because it's very hard to be good at selling if you're not authentic or passionate.
Yeah.
And actually any investor looking or trying to assess, can I invest in this, would need to be confident that this founder can sell to suppliers, customers, banks, whoever they will need to convince that, please trust me, I'll make it work and I'll make it big. So it's very much about being a good salesman, but authentic one with some passion, I think is really important, especially at the earlier stages where you have very little unit economics or almost track record to demonstrate. It's very much about investing in you and your vision, and you can't kind of get there without passion.
Right. onto the questions. So probably heard of the report from Daina's Harvard Business Review that found that when in those investor meetings, investors tend to ask female founders more risk-based questions and male founders more vision questions. A report out yesterday with Pink Salt Ventures and Daina's, they interviewed 90 founders, and out of that, 97% of these female founders said that male and female founders got different questions from investors. First question is, have you seen different types of questions being asked of founders? And also, if a female founder gets a risk-based question, what's the best way to answer it?
I think it's good to recognize the risks, but not let derail your pitch or actually getting too focused on risks. I would like to think that most institutional or professional investors are not consciously trying to be biased, and they will lead their questions based on the business model itself instead of actually whether the founder is female or male. However, if you do ask a question, I think that in my experience, the best answer would be, I recognize it's a risk and this is how I'll address it. And more importantly, this is not the first time I have come across a challenge or risk. This is what happened in the past. This is how I actually fixed it and turned it into opportunity. Because I think one of the most important traits for any founder or entrepreneur is probably resilience. It's almost never that your business plan happens as on a dot as you planned it. There will always be things going sideways, you lose a customer or something goes wrong or you lose a key talent. You'll need to kind of be able to deal with that situation. And to be honest, even in a first batch meeting, that's what investors want to get comfortable with. Can you deal with adversity? Are you resilient? Even if you're a first-time founder, that emotional resilience and not kind of freaking out in times of crisis is really important.
So the ability to articulate how you navigate risk actually could put you in a much stronger position and could give investors confidence. Billy?
Yeah, this is a really interesting question for me because it forces me to think about my own unconscious biases and whether I ask different questions to male and female founders. And I'd love to sit here and go, no, absolutely not. That's not me. But the particular example of the risk-based versus kind of more offensive one, you know, in the last 2 weeks since I read the report, I've been putting that mentality into my questions to founders, and I have found myself always asking both sets of male and female the same, you know, what is the big, hairy, audacious goal with this business? What's the huge vision? I will still also ask the defensive questions because I think they're really important to understand like how people will deal with the downside as well as the upside. But it kind of triggered me as an investor to think, if I knew more about those sort of like different types of questions and what my unconscious bias leans me towards, and I knew that, then I'd be able to address it in those meetings more effectively.
Really interesting.
I think we really need male allyship because like as much as everybody's trying to hire more female investors across all levels of organization, reality is that anybody in the financial industry, there's still majority of men. So getting men to even have not just training, but recognition or awareness that this is actually the case coming from hard data out of feedback from female founders and recognizing that it's an issue is hugely important. So hopefully we can get more men to help.
Right, now we're onto the business plan and selling the business plan. Again and again, the feedback is that female founders tend to undersell their business plan. So what would be great to get your thoughts on is how do we get the right balance between not underselling your business plan, but at the same time not presenting a set of unrealistic numbers?
So I can answer this from the early stage investing because it's probably slightly different in terms of business plans to the later stage of investing to the early stage. I think I wouldn't be remiss to say that probably every single business plan I've seen for a sub 2 million business is wrong. There's almost no chance of those founders achieving that business plan. But it needs to still be in the realm of realistic. So they need to be able to prove why they think that is possible by comparing it to the total market size. But, you know, the businesses aren't formulaic. There are going to be bumps in the road and they're going to miss it. So it is about making sure that as me, an investor, I can see that unrealistic business plan and make a sensible haircut to it and still see the fund making a return for our investors. Because I think that's a really important point thing is that our job is to make returns for our investors. And that's what we're doing all of this for. So we need to look at the business plan and make sure that our returns can be justified within it. I very rarely come across founders that underpin their business plan. It might be that they undersell, as in they're not confident enough in the vision they're going after, but actually the kind of financial of a business plan, everybody leans towards being slightly over egging it, especially at the early stages. And I think that does differ for the growth stage.
I do say it sometimes. I think actually when you look at the stats, not just from BGF, but across the market, I think women-led businesses on average raise less money because they also ask for less money, but then actually generate higher return investment on that smaller amount. What you said, I think, resonates. Any investor, no matter what stage, will sensitize your forecasts and do a haircut, and will still need to make returns work on a sensitized basis, because that's just reality. You need to assume there'll be some risks and some things won't go according to plan. But in a growth stage, maybe that's a question you can actually ask investors: what's your return profile? On early stage, you probably need to believe you can make 10x to actually justify investment. On a growth stage, it's probably 2 to 3x. So presenting business plan, and I do see it occasionally, not probably very often, if you come up with a business plan which doesn't at least double your revenue or profit, it's just not ambitious enough, because most investors are not going to back more lifestyle type of business, even if it's generating decent cash and it's more runner lifestyle. Yeah. Most investors want to back ambition to make it big and at least as a minimum double your money. So kind of being aware of, in terms of other side of table, if you are early stage, seed stage, can I make returns work on whatever 5 to 10x basis? On a growth stage, maybe it's 2 to 3. That, I think, is something to think about. You need to believe in your numbers, but equally, this promise of kind of under-promising and over-delivering, which actually I do hear quite a lot from female founders, it's a double-edged sword. And I think it's hard balance to strike, because you need to make numbers believable, but they need to be ambitious enough.
For that haircut point, it's very, just remember that you're going to get a haircut. So whatever you present, however confident you are behind your numbers, think about that, because that's what will go to investment committee. So great. Okay, I can't believe we're going to have to ask this, but something that came out a lot in the report was personal comments. So marital status, childcare arrangements, personal appearance. I can't believe founders are still getting these questions. Any recommendations for if a founder gets this from an investor? Daina?
I think that I'm a big passionate believer and champion for women. You should always have right to say no, or not answer, or actually walk out. It's a bit like going into marriage. Actually, I think doing a bad deal is worse than not having a deal. And you don't need to take money. You always have a choice until you have actually signed. So things are obviously changing across the industry. There is now lots and lots of investors who want to back more women, who will be respectful, and it needs to be business first. Your personal life should not have a direct impact to your chance of fundraising, and you should just have guts to say no. That's my primer.
Brilliant. Anything?
I also can't believe that this is still a question that gets asked, and unfortunately, I don't think the investors that do ask these questions are listening today. But obviously, it's completely inappropriate to ask any of those questions that don't, relate to the business that you're trying to invest in. I think the care question is interesting, because it probably is the most frequent one that comes up in the course of business. And going back to that, making sure that you're aligned with your investors. If there is a care issue, whether it's a child or a parent or whatever it is, it needs to be something that can be openly discussed with your investor, and making sure that conversation happens as early as it can do is really important. So there are ways in which I think these topics come up between investors and founders, but they're never in the initial kind of pitching phase. They're probably post-investment in the portfolio, when there's an open dialogue about what's best for the business and what, if any, implementation the founder's going to put in if they can't be there for a 3 to 6 month period.
Yeah, so a normal part of planning.
A normal,
definitely not as a
not
as
an initial question. Founder's choice how much to disclose. Obviously, once you get to in-depth due diligence stage, you'll do market referencing, and you'll actually ask quite personal questions on your wealth, family situation as part of kind of management referencing. But it is always founder's choice how much they disclose. And at that point, you have much more trustworthy, hopefully, relationship. So you share both ways. And I think what you said earlier is like, most founders, if it's in that age bracket that at some point they'll have kids, even if you're female and male, it's a normal business situation, and we need to all, it's just not for founders. It's almost if you want to have even women in your investment teams, at some point they will go and have off, and you need to have flexible arrangements or care to be able to accommodate that, otherwise you lose such a significant part of talent.
Yep. One thing that also came through was less about questions, but real comments, like about people's appearance. And it's really to your point about being able to walk away and to use that as a red flag, because you've built relationships early with investors, and therefore you're not desperate for the money, but that you can make a decision based on the fact that you've got lots of different relationships out there. Because, yeah, it was, as you said, it was some of the comments we heard were really unacceptable in today's society.
But it's also, I can see it's difficult to walk out.
That's what they said.
To end a meeting with a comment takes a lot of confidence.
Yeah.
And so it's also okay to smile until the end of the meeting and then say no afterwards over email if you feel more confident doing that.
Yeah. And also they said knowing which feedback to take on board, because you're going to get a lot of feedback, and which to take on board and which not, and using your intuition again about that.
Right, I know the time is romping through, but just a quick one, because it did get a lot of coverage, was around the networks. So this is from a founder's perspective, meeting with other founders, but also investor networks. It'd be great to get your thoughts on the importance of networks and where to prioritise your time.
So I think, unfortunately, network is really, really important in our industry, because the investor community is actually quite closely knit. So we all talk, we're all going to investor events and talking about the businesses that we've seen. And that does mean that if you are from a completely outside industry, breaking into it can be quite difficult. So I always recommend founders that are coming from a completely different background and have no network in investing or entrepreneurship, that they should consider going on an incubator or an accelerator, because they're 6-week free courses that you don't necessarily have to end up founding the business that you come up with the idea with on the course, but you're in the ecosystem. You've got people surrounding you with the ecosystem. You're going to have a cohort of 30 people that are all interested in entrepreneurship. And it's kind of a good foundation for which you can grow your network on. But in anything, whether it's VC or any career, unfortunately, network is really important, and you should be consistently trying to add to it. And actually having a real black book, probably now on Excel or something else now, is still really important, and kind of categorizing your network to people. This person can help me fundraise. This person can help me hire a CMO. This person can help on exit planning, or whatever it might be, is integral to the success of a CEO.
So as you meet people through that journey, keeping it
constantly
tracking it makes sense.
Yeah, completely agree. I think networking is crucial. It's never too early to start. Equally, I think there is so many female founder events now, and many organizations supporting female founders for the right reasons. But I think you need to be strategic in terms of, first of all, what's your key objective or priority?
Yeah.
Do you need somebody who can help you raise capital, or somebody who has been in your shoes and been successful founder and you can get operational or advice or help? Somebody can help you to attract top talent, and try to match the networking events with actually what is your priorities. That's kind of my first advice. And second of all, I actually think LinkedIn is quite a good tool in terms of nowadays where everything's digital and everybody seems to be reachable. Don't be afraid to reach out to people who you admire or who you think has either their own network or skill set which would benefit your business or yourself personally. And as long as you make the message personal, yes, you might not always get response, and I also get, and like we all do, get lots of inbound on LinkedIn. If you make the message personal, and especially if it's a female either entrepreneur or investor, most successful women will want to help other women. So as long as you have some capacity, you will get response for at least some people you reach out. So just don't be afraid to do that.
Yeah,
I think that has answered Camilla's question, which came in, which was all about finding people on LinkedIn.
Yeah.
So hopefully, Camilla, that's answered your question.
Yeah, I think that's a very good point, Jay. I think having that personal message is so important, so that you stand out from the crowd as you come in.
Or you could ask for a warm intro if possible. If you, as I said, most businesses, investments are on websites. So if you can find a route to any founder who that investor has backed, you can ask for a warm intro.
Yeah, and be shameless, especially on LinkedIn, because the worst thing you're going to get is a no.
Yeah, and you must remember that, actually.
Yes.
Yeah. Jenny, you just mentioned a question. I don't know if there's any others.
Yeah, we've got one other question here because conscious of time. So Tanya asks, in the current tech crunch environment, both angels and VCs are taking time to find better, less risky deals. How would you navigate this environment at earlier stage startups? Billy, do you want to start with that one?
Yes, this is interesting because it goes back to our business plan question.
Yeah.
And I do think that the times dictate what business plan you present and also what business plan you might present to different types of founders.
Yeah.
So in today's world, people are taking less risk. They want businesses that have default or live settings, and that means that they could, make redundancies and make the business profitable. So you could get through to, the next kind of boom, if you like, rather than a dip. So I think it's really about tailoring your business plan to what is the investor's desire at that stage, and it is at this stage a kind of a lower risk profile than it was 18 months ago.
Very different market.
Yeah.
Anything?
Completely agree. I do think that I think actually one of the reasons why VC stats for female-led businesses are so shockingly bad is that there is strong bias towards technology instead of creative industries. Obviously, in current markets, there is not an easy time to even raise for technology, but minimizing your cash burn or raising money before you actually need it, or at least when you actually still have a very big or reasonable runway, is crucial. You don't want to go to investors when you have 6 weeks or 2 months of cash left. Yeah. It's the worst time to be fundraising, basically.
Right, I'm going to have to stop us there. So I just want to thank you all so much for joining us today. And I want to thank you also for joining us. Hopefully you've got some recommendations, some practical tips you can put in place. And hopefully we'll see you again soon. Thanks. Goodbye.